Robert Graham and Jordan Carter, thank you for joining me today on Acquiring Minds.
Glad to be here, Will. Excited to talk to you.
Thanks for having us, Will.
You guys are both acquisition entrepreneurs. You both bought businesses. Robert, I believe you have acquired multiple businesses in the home healthcare space. And Jordan, you were a guest this past summer, and we covered your acquisition story then. But today you are both here in a different capacity as partners in Search Investment Group, SIG. That's a name that will be familiar to a lot of the audience. SIG is a firm that invests in and advises self-funded searchers. You both are proponents of the self-funded model of search, and SIG is a firm really devoted to that path. And one of the points of contrast is with traditional search funds, so self-funded versus traditional search funds. Robert, you participated in a debate here on Acquiring Minds with Greg Geronimus early part of this year. Well, this will be airing in 2023, so early part of 2022, and you were arguing for the merits of self-funded over traditional. And one of the things that came up in that debate multiple times was the fact that the self-funded search world lacks the data and visibility that traditional search funds have, thanks largely to the Stanford study that people cite all the time. It comes out, I think, biannually, and it's been published now for some number of years. Self-funded is more of a black box, and so we were all kind of flying blind in terms of being able to actually put numbers behind the merits or lack thereof of self-funded search. SIG, the two of you and the rest of the folks at SIG have now tried to rectify that. You have been conducting what I think is the most comprehensive study of its kind of self-funded searchers over the last 6 or so months, to try to bring visibility to this whole space. And so that report is being dropped today, is being published today, and it is what we are going to spend our time on in this conversation. So with that, before we dive into all of that, let me have you just give quick intros of yourselves and SIG in your own words. Robert, if you want to start us off.
Absolutely. Thank you, Will. Thanks for having us on. So my background, I'm from Texas originally. I was an engineer for several years, went back to school, got my MBA at Harvard Business School, worked in private equity on a couple of roll-ups, and then went out with a business partner and started acquiring home health, home care, and hospice companies. So we started, our first acquisitions were in 2019. We acquired 3 companies, total EBITDA of about close to $1 million. And since then, we've made a total of 6 acquisitions, and current group total EBITDA is just over $8 million of EBITDA. Should be on track to be at 10 run rate wise shortly. And I've done all of those acquisitions utilizing the self-funded search methodology. And so I, together with Jordan and another business partner, started SIG to help other searchers find and acquire businesses, and go down the same path we did, because we saw it as a great path to entrepreneurship, owning your own business and creating intergenerational wealth that not everyone knew how to approach. So that's kind of what I've been up to and who I am.
And Jordan, before you go, tell me give me a sense of the deals and transactions now that SIG has been involved in. How many, some parameters?
Yeah, great question. So I think in total, SIG, I don't know the total number, but it's well over 10 transactions we've done with self-funded searchers over the last 2 years. In 2021, we helped 6 searchers close deals. And in 2022, we helped 6 searchers close deals as well. So we closed a deal about every other month with a searcher. In 2022, average EBITDA was $2.5 million, and searchers kept close to 71% ownership in the companies that they were acquiring. So every one of the deals we're doing with a searcher, generally speaking, is a life-changing event. Most people, if you own 71% of a company generating $2.5 million of EBITDA, that changes your life. And that's a super rewarding thing that we get to be a part of, and excited to do it in 2023.
Thank you. Jordan, please.
Yeah, Will. So just to add to that too, all of the deals we talk about, transactions or acquisitions, these are the other entrepreneurs. It's their deals, right? We are in a support role. We're here to help them enable them to get the lion's share of the upside, the lion's share of the common equity. I mean, this is what it's about. Since all three of us founding SIG partners pursued this path, we did self-funded. We funded our own search. We watched our checking accounts go down month over month as we devoted to this path. We felt a calling to help other people come behind us and be successful and hopefully improve the overall success rate. So we do have what we call a full-time support program where we are in the trenches directly with live full-time self-funded searchers. We're partners together. They're going to win the most of that, right? They're getting all that upside, but we're here to support them, make sure they get all that funding, make sure they're credible out there in the marketplace, make the right decisions, save themselves time, and hopefully close. So far right now, most of our searchers that have worked with us in that program, that full-time support, have closed within 12 months. So in fact, nobody has lasted longer than 12 months. They keep closing their deals with us. So I think that's helpful. My background, so I did investment banking as an analyst in New York, and then I went into private equity as an associate. Did that for a couple years and went to Wharton Business School and really thought about pursuing a search. And I didn't know exactly what type of search. So traditional, self-funded, accelerator. I ended up feeling that self-funded was going to give me the most things that I was looking for, which was autonomy, longevity. I wanted to be able to control the company, hopefully for my whole life, right? And maybe even pass it to my children, have that flexibility, and also just benefit from the upside, right? Have majority equity control. So I did a self-funded search. I bought a company in July 2020 that does professional services and software for cities across the country. And 2 months later, started Search Investment Group with Robert and our other business partner, Aaron.
And that's Aaron Blick, correct?
It is.
Great. I'll have to meet Aaron one of these days. That's great. Thank you for that, guys. So I touched on it already about the historically, there's been this lack of data around self-funded search, but expand a little bit on that for me. What motivated you to want to do this study? What problem are you solving? And how can the searchers in the audience who are looking for a business to buy, how can they benefit from this data? Is this an academic exercise or is there applicable data here?
The whole goal of this is to be informative. When I say, the self-funded search has been the Wild West because there's no data, that's not helping anybody. It's not helping investors understand what is possible, what they should expect in investing in these deals. But more importantly, it's not helping the searcher. I've had lots of calls with prospective searchers who are considering different paths, and they're like, I read the Stanford study, I kind of know what I'm getting into there, but when I go to self-funded, it's just a black box. It's a big, opaque unknown. And hopefully this is very practical. We're not here as representing a university. We want it to be usable advice, support that can help someone go, you know what, I should probably structure my search like that. Or you know what, I'm thinking about doing something, maybe that's not so good of an idea based on the data, right? And so we're going to continue to get better with this over time. We're going to do this annually, but as a first run, I think I'll let people decide for themselves, but I hope it's incredibly useful in practice.
I think there's really two types of people that we're trying to help by releasing a study like this. The first one is groups of people deciding if they want to even do ETA, if they even want to pursue entrepreneurship through acquisition and go out and buy their own business. This study provides comprehensive data to show that this is a viable path to creating intergenerational wealth, owning your own business, controlling your own destiny. And the second piece of it is we're trying to help folks once they have decided to make that jump and pursue this path. What does a successful search look like, right? What do successful searchers look like? How much, even tactical things, right? So like how much should you be paying for, legal fees, and how much should you be paying for a QV? How long should your search likely be running? Things like that, right? What kind of terms do you need to offer to investors? So we're really, I think, helping at 2 points for folks: the decision point as to when they want to pursue this path, and also once they've decided, how to actually navigate, this river, which, a lot of people don't understand fully. For almost everyone who's doing a search, it's their first time doing it. I will say, I think that the data in this study is going to be a bit controversial for certain people. A lot of people aren't going to like that we compiled this data and are releasing it to the public. And there's a lot of, I'd call them almost special interests, right, within the traditional search investing space and within the third-party advisory space that are not going to like that this data is being released. We may, earn some enemies. I hope we don't, but we decided to do it anyway. There's searchers out there that are paying $200,000 in legal fees who don't need to be doing that. There's also searchers out there taking horrendous terms from investors, and they don't need to be doing that. And that's our philosophy at SIG, helping the searcher, and that's the purpose of releasing this study.
Well, you just touched on them, and I'm going to push harder on you for the particularly controversial bits in the data, Robert, as we get into it. And just the last step before we do exactly that is, let's hear the methodology. Where did this data come from?
So this methodology that we used, we had to really come up with our own methodology, because the methodology that the Stanford study uses has a relatively well-defined set of traditional searchers, because those are folks who have taken capital from a certain subset of investors on certain terms and with certain stipulations. So that is a pretty well-defined cohort of people. Self-funded search is not well-defined at all. People start searching for a business to buy and stop searching and pause their search and search part-time, and it's not well-defined at all. So we had to come up with a novel way to collect this data. And what we did was we decided the best way to find a good selection, and also randomly select participants, was to leverage social media. And so we utilized 3 social media platforms: LinkedIn, searchfunder.com, and Twitter, to find people who self-identified on those platforms as self-funded searchers, or who could pretty readily be identified as self-funded searchers. And we sent over, we hired a third-party firm to help us randomly select participants from those social media platforms. And then we sent close to 1,000 invitations, a little more than 1,000 invitations to folks to participate. Once they agreed to participate, number one, we filtered out more than one submission from an IP address. So an IP address could only submit one time. And then in addition, we also filtered out anyone who didn't self-identify in the survey as a self-funded searcher from the results. So we think that was a relatively good way to get the responses we did and to focus on the responses that we decided to focus on. So we ended up getting close to just over 270 something responses to the survey that were usable responses, which we believe is a pretty robust data set.
Great. And as you said, it is challenging to identify people who are who are in this black box of self-funded search, and how fluid it is. They're in, they're out, they're searching, they're not searching, and so on. So there is at the end, to your credit, at the end of the report, which I'm looking at here, a little bit of an appendix on shortcomings that you guys recognize that are just kind of inherent to the process and inherent to the very opaque and messy nature of self-funded search. Why don't you just highlight those a little bit first? Jordan, you want to take that one?
Yeah, sure, Will. So, Robert described a little bit of the methodology, which inherently is different. It's going to be different than the traditional search fund study that's out there that everybody's used to. And I think it is the fact that it is a sample has inherent, questions of where does the sample come from? How did you assemble the sample? One of the things to follow up what was just discussed is that surveys were not pulled out for any reason other than those reasons, like technical issues or some kind of a duplicate or something, just to clean the data. We never looked at answers and said, this doesn't support our approach or something like that. We pulled it all in and just looked at the data, and we're releasing it. And honestly, we're going to use this going forward this next year, right? To look at things and kind of read some things out, read the tea leaves a little bit. So if it's useful for us, we clearly took that approach. So the fact that it is participative, I think, is one of the first ones that could potentially have an issue, right? So you might argue that someone would only participate in this study if they had kind of a good experience, right? Why would someone even respond? In fact, people do this all the time, particularly with self-funded search. They put on their LinkedIn's that they are doing a search. They get their search fund name, their website. I've seen this a couple times now. I go back, I check in with someone. Hey, how's the search going? I look at their LinkedIn, it's gone. It just says they were an independent consultant. So I think there's a natural human drive to kind of dust that under the rug and kind of move on. And that person's probably not going to also participate in the survey itself. The other thing is, yes, we had IP addresses that were pulled as part of it, but they were scrambled in terms of knowing which responses did which. Right? We don't know who said what. We just know that this many people responded, and here's the data. So I think from that perspective, we're going to get as honest of a response as we can get. But yeah, that's what I saw. Robert, do you want to share any other shortcomings?
Yeah, I think, you already kind of touched on it, Jordan, but the fact that the self-funded space is not as well defined as the traditional space, you've got people starting searches all the time. And so there's really no data in here or conclusions that can be drawn related to the success rates of folks during the search phase, right? That data is, so far, we have not figured out a way to reliably, pull that data and infer from it. So that's, obviously one big piece that's missing here. And then the method we even use to send the invitations, you could argue there are shortcomings with that, right? So going through social media. Well, number one, the subset of searchers who are on social media is probably different than the total population. In addition to that, if you think about the people that would have been sent invitations by the third party we hired, that contracting firm would have received, would have seen other profiles of self-funded searchers that were in our own network or in, networks that were closely tied to ours, right? Our second and third level order networks at a higher rate than they would see people that were completely out of our network. So that in itself would have, in some ways probably biased the group of people who were invited to participate in the study. There's also some signs even of, some bias. For example, something you mentioned, Will, in our email, there's a relatively high percentage of respondents with MBAs. That could be reflective of a few different things. And another thing to notice is a high percentage of post-close entrepreneurs that were respondents had been only operating their business for a short time. So, close to 80% less than 3 years. 3 years or less. And that could be caused by a lot of things. For example, our own networks could be relatively early in the ETA space, which could have led to that. There could have been rapid growth in popularity in the self-funded search path. And so because of that, the folks who are responding are relatively early in the process at a higher rate than really the overall population. And then it could be that older or operating or exited searchers are not as present on social media and are not publicly identifying themselves as searchers on social media. So there's all kinds of biases and shortcomings this survey could have had. We tried to do our very best to eliminate as much of that as possible and use reasonably, statistically kosher methods to collect this data. And I think we overall did a really good job at a really difficult problem.
Yeah. Thank you for that. That's great. And I think it's great that you guys acknowledge so transparently these potential shortcomings because obviously data is only as good as kind of the collection method. But with all of that understood, it is still the only thing like it out there. And it is a lot of data. And so how I want to proceed with this is I want to give the audience just kind of a high level kind of chapter by chapter what's included. But there are so many data points here, we would spend hours in this conversation going through each one. So we have each of us, all three, kind of come up with a few findings that were particularly interesting to us individually, and we'll go through those. But before I ask you for each of yours, let me just paint a picture for the audience here. So it's how many pages? It's a 70-page report. And the way you guys have laid it out is kind of in the sort of chronology of an actual search. So you start with what kind of the demographics and background of searchers looks like. So that's kind of interesting. What does a self-funded searcher look like? Then you go into data about the search phase. So things like part-time versus full-time. How many hours a week are allocated to a search? The range, the EBITDA range, the revenue range of the acquired target, cost of living during the search phase, solo or partnered, sourcing the acquisition, what methods are people using, intermediary versus cold outreach. So that's kind of a lot. There's a lot of data there just under the search. Then you move into the actual acquisition phase. Lots of, more data around the acquisition phase. We're only halfway through. I mean, this thing is really robust. Then funding, how searchers, self-funded searchers, use debt, use equity, work with investors, what the parameters that have emerged, what that looks like. And then the operating phase, that's a slightly shorter section. And then finally, the returns, both for investors and for searchers themselves. So it really, as searchers are out there and perhaps using this as a resource, they can kind of, drill into wherever they are in their search. They can kind of map that to that part of the report and really, quickly cross-reference like what they're experiencing with what the data shows. So it's laid out really nicely and intuitively that way. That said, I actually want to start with the last page, the last finding, which is in the returns section, the net equity proceeds to the searcher. And that's really like, what did a self-funded search do for the net worth of searchers? And the reason I want to start there is because there are many reasons that people get into search, but obviously financial benefit is probably the top, or certainly top 2 or 3 reasons. How much real wealth can be generated by this path? And I think we all believe that it's significant, and that's why so many of us are interested in it. And this puts some numbers around that. Robert, why don't you tell me what you guys found in terms of the net equity proceeds that self-funded searchers enjoy in aggregate?
So sure, Will, happy to talk about that. And before I say, mention my highlights here, I think it's really important to view these all within the context of who the respondents are. And that gets into a really important point that I made earlier in this conversation. 81% of respondents had operated their company less than 3 years or less. So that's really important here, right? And within 3 years or less, 53% of searchers would have had proceeds of over $1 million. Okay, 29% would have had proceeds of $3 million or more. That's pretty incredible. So I think the big takeaway here for me is this, clearly looking at this data, it appears that self-funded search is a reliable path to making several $1 million and creating true intergenerational wealth. It's probably not a reliable path to earning several $100 million, but it's definitely one where you can create intergenerational wealth with relatively high probability compared to other forms of entrepreneurship. So I think that was a great takeaway from this report, and one hopefully that's encouraging to a lot of people considering this path.
Yeah, excellent. Thank you for that, Robert. Jordan, why don't you share with us a finding that struck you?
Yeah, and Will, on that point, 86% of searchers in the study that people will see retain greater than 60% common equity ownership. So not only are they generating the returns that Robert just shared, that if we basically ask the question, if the business were sold today, what would be your net equity proceeds, right? And Robert just shared those numbers. Well, you look at kind of the average size of the deals that people are doing, and they're retaining substantial majority equity control. They're actually going to govern if and when they sell. So that's not including the cash distributions that CEO and majority owner is keeping throughout the life of the hold period. That was just looking at the exit.
Actually, and Jordan, let me also add something to that. So you have 10% of searchers would say 10 million or more, 12% 5 to 10 million, 2% 4 to 5 million. So essentially 25% of searchers $4 million and above, and 10% $10 million. So according to this data, which we've caveated, but 1 in 10 searchers, this has been a path to have $10 million in net worth. And 1 in 4, almost 1 in 4, call it 1 in 5, $5 million and above. So that's really quite striking. Like when you look, when you look at the top 10% or the top 20%, it becomes, really eye-popping, these numbers.
Those percentages are only reflective of searchers who have closed deals. So it's not like 10% of self-funded searchers are going to end up with proceeds of over 10 million. That's only the subset who actually bought a business. I want to make that very clear. Yeah.
Yep. Thank you.
Yeah. So Will, on that point, if you look throughout the study, you're going to find clues that kind of come out of the data. How do you get there, right? I think who would not pursue self-funded search and try to go for that, right? Try to go for a 5 million, net equity proceeds or 10 million net equity proceeds. And, one of those things you can do is to buy larger, right? Because you can still retain the same, north of 60%, 60% plus common equity retention at a $1 million EBITDA or a $2 million EBITDA deal. And you can put 80% plus debt on the business. This all helps you unlever and create those net equity proceeds over time. So to me, what's also striking about that is that a lot of these deals are being done with 80, 90% debt to value on the business. So when you buy a company at, let's say, 4 times or 4.5 times EBITDA, now you've demonstrated to the entire world that company can transition ownership successfully. Let's say you run it for 2 years, because that's always a question. You buy a company that's been around for 20 years. Can it survive? Will the employees leave you? Right? Are there tons of skeletons in the closet and they're all going to come out? So by the fact that you demonstrated that actually can transition ownership, it becomes sellable. Your company now can be transacted again, and people don't have that question mark of, I don't know, can it sell? So that actually helps. Certainly growth helps increase your valuation multiple. But yeah, there's all sorts of different inputs into that. But yeah.
Let's drill in a little bit to the post-close performance. So to the extent that searchers grow revenue and or grow EBITDA, obviously now we're talking about searchers who have closed, because we're talking about post-close performance. So one of the things that struck me was how the number of successful searchers who close who saw revenue and EBITDA decline was reassuringly low. So for EBITDA performance, I think it was 9% saw EBITDA decline post-closing. Reassuring, of course, because the big risk here is that you buy a business and then the business starts tanking or going down for whatever reason. Either you bought a lemon or you're mismanaging it. So nice to see that happens less than 1 in 10 times. And I'm talking about EBITDA performance, not profit performance. Now, what was interesting to me is actually it was a bigger number that maintained EBITDA performance. So it looks like about 54% of searchers maintained. I actually would have thought that there'd be more who increased profit. Almost 45% grew their businesses from a profit perspective, but a large 54% maintained. Did you guys have a reaction to that?
Yeah. First of all, that's incredible given the short hold period that on average the respondees indicated. So when you come in there, you're one of the things we don't know whether the respondent was comparing to EBITDA, pre-loading in kind of all the post-close operational expenses they have to put in. I mean, I'll tell you, for me, I had to hire a controller, I hired a director of operations, an operations analyst, a bookkeeper, and added my own salary in there and still grew EBITDA. So it's tough to do, but I think the fact that there's people that have maintained EBITDA so far in such a short hold period is a good indication of things to come to get their feet under them.
Will, I think there's 2 really important things to realize when you look at the maintenance percentages, the folks who have maintained EBITDA, and compare that to the amount of folks who have who would expect pretty high proceed exits from their business. And the first thing here is the great thing about self-funded search and utilizing a leverage structure to buy a small business at a low multiple is you don't have to knock it out of the park to make great returns. That's the truth of the matter. These businesses generate good cash flow. They pay down debt. They pay good distributions because people are buying them at 3 to 4 times EBITDA and putting on 80% LTV. The returns are just through the roof because of the nature of how these businesses are being acquired. And so maintaining EBITDA isn't a bad return situation, actually, for these entrepreneurs, which is an incredible takeaway here, right? You don't have, this isn't VC. You don't have to knock it out of the park. You just have to not let it go off a cliff. And so, there have been a lot of people who haven't knocked it out of the park, but are maintaining the business, and they're doing just fine. So I think that's one thing. And the other thing here is, again, let me point back to the fact that, 80% of the folks that were responding to these questions were under 3 years of hold. Okay. So that's not a ton of time. If you're holding a business for 2 years to have, the chance to grow EBITDA a ton. And that's usually what happens, right? When someone buys a new small business, there is oftentimes a slump at the beginning where you're learning the operation, you're turning things around, you're heavily investing in growth, and then that turns around. So I think that it's not fair to assume that those businesses won't grow in the future. They probably will. It's just a relatively short hold period we're looking at, and they're generating great returns even while maintaining the current level of EBITDA. Mm-hmm. Now, I think one thing about the performance that's a huge takeaway for me is revenue. And EBITDA is probably going to catch up. But look at revenue in those numbers. A very large percentage, I think it was 15%, had increased revenue by over $5 million. That's not that impressive when you think about a big business. But it is impressive when you consider that 75% of the acquisitions in the study had under $10 million of revenue. So you're talking about people growing revenue by 50% or more, 15% of them growing revenue by 15% or more in the first 2 to 3 years on average. That's pretty amazing.
Excellent. Robert, back to you and any finding that you want to pluck out and share.
Yeah, I think a big highlight for me that was, really an important one here was that, searchers are overwhelmingly ending up with true, pure controlling ownership of their business. Of the searchers we studied who had closed a business, 42% had boards. Of that 42%, 55% controlled the majority of the board. And so if you assume that the ones who didn't have boards, controlled their businesses for the most part, you could draw the conclusion that north of 80% of the self-funded searchers who closed deals in this study effectively maintained control of the acquired company. That's incredible. And I think that really points to the fact that if you pursue this path, there's a very, very strong chance that you have the ability to acquire a business that you will control and effectively, own and control fully, which I think is great to see. And really proves out the path.
My reaction to that, Robert, is that is great news, but it does kind of just reaffirm what we all already understood about self-funded search. That's one of the strong arguments for self-funded search, is that compared to traditional search funds, for example, is the level of control that you retain, and so now we see that borne out here in the numbers.
Yeah, I think it's important, though. I think it's an important point for people considering this path who are questioning whether they really can control their own business, because they're getting information from a bunch of other different sources, including investors on the traditional side, saying that it's just unrealistic for you to control your own, control and own your own business. And you can see right here in the data, that's not unrealistic. That's very real.
Jordan, what other finding struck you?
Yeah. So, Will, throughout the study, again, if I were starting over and this existed, which I wish it had, it's leaving clues, it's giving insight into how to set up a search, and or if you are considering doing a search in the future, what kind of experience you want to get to maximize your probability of success. Just like startup entrepreneurship through acquisition, I'm pretty sure everybody who does this and everybody who does a traditional search even, they all want to be in the bucket that not only successfully completes a deal before 2 years completes, but also is in the top tier and generates the most returns and wins the biggest, right? But at the end of the day, it is a statistical game. You can influence the outcome, and you should use some of these insights in order to do that. So out of the 279 respondents, of which some are still searching, so that is a caveat, but only 39% had successfully acquired a business. So to me, it tells you that this is not an easy game. It's hyper competitive, right? It's 2023. There's a lot of people doing this, and there probably will be more people doing this as the economy continues to degrade at a macroeconomic level. We saw this happen in 2008, 2009. It creates more searchers. So it's going to get more competitive. That being said, there are a lot of part-time searchers out there. I truly believe that going full-time will enable you to devote the amount of time necessary to increase your odds of success and not let things creep in like, oh my gosh, my checking account is now getting to a dangerous level, or my spouse it can't take this anymore, or I can't mentally take it anymore, kind of thing, right? So there is advantages to moving fast. And how can you focus your search in such a way that maximizes your opportunity to get that one sell, that one sale, which is what you're going for? I think that's very insightful.
Yeah, no, that is interesting. And let's just also talk about that private equity observation. I've heard searchers express intimidation by the fact that it seems to be that there are a lot of former private equity people doing search for obvious reasons. They're basically doing search at a professionalized level in private equity, and then they say to themselves, hey, why don't I do this individually? But it turns out that maybe those are overrepresented in our mind. The participation of former private equity folks is actually fewer than we think. And Jordan, you just had a kind of an interesting anecdote about your own psychology when you did have it come from private equity. Obviously, you are former private equity who did successfully acquire a business. But it actually, in some ways, got in your own way because of your private equity training. Elaborate on that. That was interesting.
Yeah, well, I think that the interesting thing about private equity comes from the fact that when you are essentially trained and every day of your life as an investment team associate is to really be selective. I mean, you look at the pipeline of deals, let's say in the lower end of market, where that's where I was, anywhere from about $50 million in company value up to $750 million in total enterprise value of companies we were looking at. And we would go through thousands of companies, look at thousands of SIMs, right? Talk to investment bankers, right, for those size of companies. And we would turn away so many different companies and go to investment committee, and people would find the one thing that made us not want to hold that in our portfolio. So it does make you very selective or picky. And now you're about to go down to companies that are being bought for between, my target was between like 5 to 15 million. I know a lot of self-funded searchers are looking at total enterprise value of 2.5 million, up to 7.5 million. But regardless, it's a different type of company. And when you come into these companies, you're going to have to load in a lot of management team operational expenses, fix things, right? And not necessarily turnaround, but none of these companies that we look at and that we support in partnership with our full-time support searchers, none of them would pass the criteria to be able to acquire as a private equity associate. You would be embarrassed to send that on to your partner. And yet these are fantastic opportunities, but you just have to target your scope or rescope it, if you will.
I just wanted to add something to Jordan's answer really quickly. I spent some time at a PE firm also, and the M&A market at the level of 25 million of EBITDA north of that is completely different than the M&A market at 1 million to 5 million of EBITDA. It is a different universe. And I think folks with PE backgrounds come into self-funded search with a bunch of preconceived notions about how things should work in terms of sourcing deals and closing them. And that can be a real hindrance because they will go months before truly adjusting to the realities of the lower middle market. Give you one example. You can look in the study and see 2.4 executed LOIs for every closed deal. But if you thought about my experience at a PE firm, right, if you submitted an LOI and it got executed, there was probably north of a 75% chance of the deal closing. That's just not the case here. And you're not on the other end of the table from Goldman Sachs. You're on the other end of the table from a broker or no one and just dealing directly with the business owner. It's a very different environment.
So just for the searchers out there who don't come from private equity backgrounds and feel that they have a disadvantage there, maybe it's just the opposite. Maybe the private equity folks get in their own way, and you not coming from that background are maybe more clear-headed about the opportunity than private equity folks. So, but talking about kind of credentials and backgrounds, let's talk about this MBA number. So 63% of the searchers who responded to the survey had an MBA. That number was very large to me. Obviously, a lot of my guests indeed went through MBA programs. So I was expecting to see, a lot, but 63% is almost like, wow, if I don't have an MBA, should I be playing in this game? How did you guys respond to that number?
Well, I'll say this first of all, most of the top MBA programs now teach ETA or Surge as part of their curriculum, and they churn out a ton of searchers every year. So it's not that surprising to us. I'll also caveat the number that you cited, Will. Part of it is probably due to some of the shortcomings of our study, right? So invitations were sent to folks through social media, and there was bias likely there in terms of who would receive an invitation because of our own networks within social media. Even though those folks were randomly selected by the third-party firm we contracted, there was still a higher likelihood that folks within our own network would receive an invitation. So that is, a shortcoming that we need to acknowledge. If you don't have an MBA, I don't discourage you from pursuing this path. We've had several SIG searchers without MBAs be incredibly successful at this, and I don't think it's necessary.
Yeah, I'll add to that just sort of anecdotally. I think you're right. I mean, the three sources of your survey respondents, SearchFunder, LinkedIn, Twitter, the feel of the search communities, each of those, they have a feel. And SearchFunder is very kind of education.
Yes.
I mean, you see a lot of MBAs on there. And in fact, SearchFunder has kind of baked that into the user experience. I mean, everybody's got like where they're at school or where they went to school, like right next to their name. So naturally, there's going to be a preponderance of MBA folks coming from that community. Meanwhile, on SMB Twitter, a lot of the big names there, I don't know them. Their educational bios aren't right there on their Twitter profiles, but I suspect a lot of those folks are not MBAs. And so this is just, again, to echo what you just said, Robert, this just kind of comes down to where the data came from. But to amplify what you said at the very end there, Robert, people should not be discouraged if they don't have an MBA, even though when they see this big number in the data.
Completely agree.
So Will, we even, one of our full-time support searchers just successfully completed an acquisition, and his background was Marine Corps officer, no MBA. There's all sorts of ones out there that are successful doing this. I do think at a business school, there's a little bit more of a bias to go bigger and to seek that a little bit more comfort in raising capital from investors, because pretty much everybody who touches foot on campus at a business school where search is discussed has heard a presentation from a traditional search investment firm or an accelerator investment firm. And that is by definition investor capital. It's just coming up front before you even start searching. So there's a little bit more, again, to those shortcomings. There's a little more of that bias towards that kind of model. And, I recently did a poll on my Twitter where I asked just the people following me, I said, hey, what size companies are you looking for? And overwhelmingly, it was smaller. It was a smaller size of company. So I think you're right. Will, there's a little bit of a cohort kind of scoping effect. Yeah.
I just want to interject here with just an observation of kind of the in the aggregate what the LOI numbers just piggybacking on the stat that you just pulled out, Robert. So what do successful searches look like according to this data? Searchers that successfully acquired, I'm quoting now, acquired targets submitted an average of 6.9 LOIs during the search phase, with 2.4 of those LOIs executed on average. So the average self-funded searcher puts out 7, and 2.5 are executed.
Yep.
Yeah. And then the median total time between discovering the target, so not necessarily sending the LOI, definitely not sending the LOI, just discovering the target, the business that you want to go try to buy, to actually closing the deal was between 4 and 6 months. So that was the median.
Within Pillar Health Group, we've had several deals that have taken, unfortunately, over 3 months to close. And I don't think that that's uncommon at this level. These deals have more hair on them. And oftentimes you're dealing with the SBA, which requires a ton of documentation before you can close. And oftentimes the seller is involved in day-to-day operations of the business, so they can't just drop everything and collect all the data you need. So it's not uncommon at all for the phase from finding the business to closing to taking several months, unfortunately, but that's just the reality of the space. Yeah.
Yeah. Jordan, did you want to add something?
Yeah. So, Will, this is part of the make or break of your search. If you're a self-funded searcher and you're putting it all on your back, and it takes you on average 4 to 6 months from discovering a target to successfully closing a deal, and you combine that with the submitting 7 letters of intent and only 2.4 of those essentially getting executed before successfully completing a deal, time moves pretty fast. So you go after 1 or 2 deals that ends up dying at the 4th or 5th month, you've already exhausted over half of your search or close to it. I know some self-funded searchers who actually are still searching, and it's been like 3 or 4 years. It's rare. But most people set a timeline to this. They say, you know what, I'm going to give it 24 months. And that's just what makes this all the more meaningful for you to find those things and make sure you're making the right decision when you're going after a company. Because the sell side, the broker and the seller will happily entertain your process and carry you all the way through because they want to sell their company. But what if you discover in that at month 4.5, you're like, oh my gosh, I just discovered a deal killer. I cannot do this business purchase. This is my life, right? This is my career, putting my personal guarantee on the SBA note. So again, just goes back to making sure you're making the right calls. That's critical to success.
Let me add one more thing to that. So we're talking about the time period from finding the business to closing it. But also in the study is the time period from deciding to start a search until closing on a deal, right? And if you look at the searchers who successfully acquired companies, those are pretty encouraging numbers. 53% of searchers who acquired companies did so within 12 months, and 83% within 24 months. Those are pretty good percentages, I think.
Yeah. But the people who successfully acquired, they did it within 2 years, basically.
Yes.
Robert, at the top, you had given as an example a sense of costs, deal costs, as one of the ways that this report can be really applicable to a searcher. So let's touch on that really quickly. The 2 big costs discussed in the report are your quality of earnings report costs and legal costs. What did you find there?
Well, Will, I think it's really important that we collected this data. I'm so glad we did. There are, unfortunately, there's a lot of advisors in this space who, in some ways, I think almost take advantage of the fact that self-funded searchers often have never closed a deal before, and they don't really know what's necessary in terms of spending on legal and accounting due diligence and other forms of due diligence, or when to do those diligences, when to turn on an advisor and start paying them. So I think, important takeaways here. 85% of searchers in the study spent less than $30,000 on a Q of E. 68% spent less than $50,000 on legal due diligence and document prep combined. So you do not have to spend an arm and a leg here. You do not need to go to Deloitte and get a $150,000 Q of E done. I didn't do it. Jordan didn't do it. None of the searchers in SIG do. And really, very few of the searchers in the study did that also. So you can really get the due diligence you need done for pretty reasonable costs. The other really good news about deal costs, 75% of searchers racked up less than $25K of dead deal expenses. So even though, less than 50% of LOIs that get executed lead to an acquisition, folks are mostly walking away with dead deal expenses that aren't terrible, right? Almost everyone's walking away with less than 25K of dead deal expenses.
And Robert, just pull out, you had kind of gone through the number, but just so people have a quick takeaway. What do you feel based on your experience and then based on what the data is here? What is the band, the range that a Q of E costs, and then legal expenses per deal?
Well, Will, you can spend as much as you want on either one of those things. But, kind of the numbers I spoke to, almost everyone spends less than 30K on a Q of E. Most of, our SIG searchers are spending less than 30K. I would say a typical Q of E is probably going to cost you, and these are numbers outside of the study, somewhere between 10 and 25K. You can get a really solid Q of E done. And on legal diligence, like I said, 68% spent less than 50K. Our searchers are typically spending somewhere around 30K, 25, 30K on legal diligence and document prep. That's really all you need to spend unless it's a very complicated deal.
Robert, these were a couple of the points that you thought might attract a little controversy. Were there any other points that were controversial in the data? Now's the time to stir it up.
Yeah. Well, I like to do that, Will. I guess the other points of controversy are things we already talked about, right? Where, I'll say one that we haven't really touched on that much, but we kind of did, is boards, right? The whole mantra on the traditional search side is that, these crazy self-funded searchers are going out and buying companies, and they're cowboys. They just run them however they want, and the investors don't have any control at all. Well, even though that is true oftentimes, the wild part and the, cowboy part's not true, but the control part is true many times. There are a lot of self-funded search deals that have formal boards, right? So this whole idea that none of them have boards or any kind of oversight, I don't think that's very accurate. You look at the data, 42% of the businesses had a formal board, which is, I think, obviously counterintuitive to what has been the message out there. The other piece of it is that, I think a bit of a controversial one here is the ownership that searchers are able to keep, right? I think that there's obviously a lot of investors on the traditional side and even some on the self-funded side that have their own self-interest to watch out for. And that self-interest includes trying to beat searchers down to give them, the worst terms that searchers will take. The fact of the matter is, from this study, you can see that, searchers are getting great terms. If a searcher used a preferred equity structure, 86% of the time, they kept over 60% common equity ownership. That's pretty incredible.
Jordan, what other findings do you jumped out at you?
Yeah, so a big finding for me is everybody's always asking, how do we set up a search? Should I focus on one or two industries? Should I go broad? I think it's kind of clear in some of the charts here and the data that pursuing a industry opportunistic strategy, that's what I would call it, a generalist strategy, had a higher representation in the acquired searchers versus the 1 to 3 target. Now, I think this gets really this doesn't mean you're just shooting a shotgun and just like having no discipline to your search. and just taking anything that comes at you. You know, what I'd like to know beyond that is how people set up that industry opportunistic strategy. In my own search, I had essentially a selection of a few industries that I was pursuing pretty fully, and then as one or two of those kind of disqualifies themselves through some early, primary research, I would funnel those out and I would replace them with more industries. So it's not like you're looking at 20 different industries all at once. That being said, you do have to have that component of your search that is devoted on a weekly basis to actually responding to and being open to industries that are outside of something you ever thought you'd consider. Personally, I never knew I would buy a company that was going to serve cities with professional services and software as a essentially a business process outsourced service in grants. I never knew that, right? But I was open to the opportunity that maybe there's something here. And most of these, a lot of self-funded search industries of interest are niches. They are niches you've never heard of, and those are often some of the best businesses and best subsets of industries broadly in which you can take territory easier. The competitive environment is lower, even if the barrier to entry is relatively high, right? It doesn't necessarily have to be fragmented and easy to start a business in that space. But if the total addressable market is $150 or $200 million and your business is making $5 million in revenue, you have a lot to go. You can do pretty well. So I think that's a really good insight that people should feel confident about. But it does open up that question of how do you make sure you do it in the most efficient way possible and not burn time going after deals you shouldn't, given the fact that you're going to look at industries you don't really know about.
Great. Guys, let's talk a little bit about structure of deals. So I was surprised that, do I have this right, that 45% used some form of seller debt financing or a seller note? That struck me as low, just because I have kind of assumed that some piece, 5, 10, 15%, at least for an SBA deal. I mean, almost all my guests have used seller notes. So I was surprised that actually it's just a little bit less than half did in this data. So can you react to that, Robert?
Yeah, I think, Will, you asked me to stir things up a little bit. So I'll inject a bit of a controversial opinion here, or maybe counterintuitive opinion. The conventional wisdom, I think, out there within a lot of groups is that you should never buy a company without a seller note. I've heard a lot of people say that. I would never buy a small company without a seller note. That's just not really a fair blanket statement to make. A lot of people, I think, don't know that seller notes aren't required by the SBA, and they may not always actually be the best option. You can look at the numbers in the study and see that for the most part, the seller notes usually have shorter terms, and amortization likely than SBA debt, right? So 81% of the seller notes, in the study had terms less than 10 years, and a large percentage of those were within just less than 5 years. So that's not as attractive necessarily as for example, SBA 7A debt, where you've got a 10-year amortization and a 10-year term. I'll also mention that the interest rates are not as low as people may think. So 56% of the seller notes in the study charge an interest rate of 6% or more, which doesn't sound as bad today in the current interest rate environment. But keep in mind that a lot of these deals were closed, in the last 2 to 3 years, the ones that are, when we're looking at them in the study. And so, an interest rate over 6%, a year and a half ago wasn't nearly as attractive as it would be potentially today. So I think that folks who think that, seller notes are this huge source of value, I don't think they're necessarily all they're cracked up to be. I personally would be comfortable closing a deal without a seller note if it was the right deal. And I'll say that I think they're nice to have, but I don't think they're a necessity. And the study proves that.
What about the sort of psychological alignment of incentives that you get your seller in there and on board and incentivized to, help you transition the business as successfully as possible. They're incentivized to see you be successful. So putting aside any financing, any rates, any of the kind of the numbers, just pure getting them on your team to make sure that they get paid out 100% of what they're due. Don't you think that works pretty well as a technique?
There's definitely an argument there, Will. And that's the conventional wisdom. So I don't think I'm adding anything by just agreeing to that. So I'll give you a counter argument there. I think a lot of sellers immediately discount a 5, 6, 7 year, 10-year seller note as being potentially lost capital anyway. I think that they kind of put it as a gamble. And a lot of attorneys advise them of that. So, how much value are they really putting on that anyway? And usually seller notes are 10% or less of the total deal. So, sellers usually walking away with several $1 million. And I think they're putting a low probability of payback on that extra 10% anyway. Still, hey, look, seller notes are nice to have. All I'm saying in here, and clearly from the study, it's not necessary.
Yeah. So there are other ways. Why is a seller note useful is, Will, what you said, which is that it adds a little bit of alignment. It adds incentive to the seller to want to make sure that not only you as the buyer are successful, but that they believe that the company is going to survive through the transaction, that there's not something waiting to just explode. Well, in my deal, in the business that I purchased, there was no seller note. What did I do instead? I used an escrow. So there are other methods you can use. You can set money aside. Mine was on an 18-month escrow. Everything I was going to find about that company, whether there were skeletons in the closet or issues that would have been not disclosed properly, I would have figured out, honestly, probably within the first 3 months. So 18 months is sufficiently protective, and that money sits in a neutral third-party account that is managed by essentially a trust company that only releases it upon successful completion of that time period and having no outstanding claims against that escrow. So you got to be creative. If a seller doesn't like want to do a seller note, it doesn't necessarily indicate that they don't believe in the company. They may be open to other options, or they just want something a little bit shorter. I just wanted to add that.
Yeah, that's great. And just on the point about the kind of relationships with sellers, one of the things that jumped out at me was the overwhelming frequency of positive relationships with sellers post-close. So I think the number was about 80%, high 70s of acquisition entrepreneurs have what they would consider a really positive relationship with their seller. Maybe that's not surprising. I mean, deals usually torpedo if the relationship gets sour. But it is a theme on Acquiring Minds over and over and over, building the rapport, the trust. That's really often kind of the ingredient that doesn't show up on paper, but the key ingredient that gets the deal across the finish line. And that, I feel like that's kind of borne out in this number. Did you guys have a reaction to it?
So I have a very positive, I would be in the extremely positive, cohort in figure 42 on this question. And I'm not really that surprised that there is a positive, relationship with the sellers, given the way that the companies have performed based on the data that we've gathered in the study. It also indicates, there is a correlation between people who successfully close business purchases with a seller, very personal thing. They probably liked you. Yes, money is a component of what they're considering, but in an environment where maybe there's 5 different self-funded searchers who are all saying the same thing, I can take care of your legacy, I'll take care of your employees and your customers, they're going to go with the one that they feel the most akin to, and they feel like they could actually be proud of introducing to their friends, to their family, because it is a personal, engagement. It's not just a transaction. So I think there's a little bit of correlation there between the people who are successful, they've developed good relationships, good rapport with the seller, and that just only continues post-close.
The numbers were very surprising to me, given my personal experience, because I'll just tell you, in our deal, the first deal we did within Pillar Health Group, the seller, we got a letter from the IRS within about 3 months of closing, proposing several $100,000 of fines. We had to call the police on the seller and ended up in a several $100,000 lawsuit with them. So it was definitely counter to my experience, but we'll have to do a separate podcast on that experience, because it was pretty colorful. But it's awesome to see that 78% of searchers in the study had positive relationships with the seller. That's great to see, and it's obviously another argument for this path.
Well, gentlemen, I want to start winding up here. Is there anything about the report or the data that we didn't touch on that you really want to make sure people hear before we close?
One thing I was going to mention really quickly is a lot of folks think that if you go the self-funded path, you really need to go buy a business and buy a small business. And the fact of the matter is, a lot of self-funded searchers are buying larger businesses. They're utilizing really attractive debt structures like SBA debt, and they're also bringing in outside equity. So one thing that was kind of surprising, I talked to a lot of self-funded searchers who have no concept of the fact that you can go raise equity from investors, which is one thing that SIG does, help searchers do all the time. And we do a really good job of helping searchers do that. But 62% of the searchers in this study had raised outside equity to help fund their acquisition, while self-funding their actual search phase. So don't limit yourself to buying a 200K EBITDA company. Searchers, you can get out there and look at larger companies and put in place pretty attractive debt structures and also raise equity on really attractive terms to buy a larger business.
Jordan, you want to say anything to close out?
Yeah, I think it's related, Will, which is that there is something quite special about focusing your search between roughly 1 million and kind of 2.5 million of EBITDA. If you look at the acquired EBITDA by acquisition multiple range, so looking at basically how much you're paying for that EBITDA, all the way up to 2 million, the group that spent less than 3 to 4 times EBITDA to buy the company was 46%. So between $1 and $2 million of EBITDA. So you can buy at a really good valuation that is able to generate cash flow even at 90% debt to value, and just maintain the EBITDA level of the company and watch your equity creation personally flourish. And I think that is part of a big upside of doing self-funded searches, because you are going to be the majority benefactor of that equity value creation. So focusing on that size range and working with investors to help you fund it or fund 100% of the equity capital is just a fantastic opportunity to generate really over year cash flow to yourself, and ultimately an asset that you can hold forever or sell at your discretion.
Well, SIG and the two of you are very vocal on this point of size of deal, and it is something that probably, as strong believers as you are in it, you need to be vocal about, because so many folks, when they decide they want to buy a business, aim a little low. We were talking about this pre-call, probably because they're intimidated by buying a business with $1 million in cash flow. I mean, that's going to be a larger business, so there's more headcount there. It's a big scary number. It's a bigger personal guarantee, and so on. And so the reflex of many is to buy something that's $200,000, $300,000, $400,000 of SDE. And I have to admit that my own kind of reflex has continues to sometimes be that. Although I've heard you loud and clear, and the argument for buying bigger if you can get it is basically pretty clear, is very clear. So anyway, it's been kind of borne out in your data here, but I know it's something that you're really, really strong on. If you can find that business, that is another reason people buy a little smaller, is because finding that $1 million EBITDA business is no easy feat. So there's that. Guys, I want to close out, but tell people where they can find this. So we're talking now in just at the end of the year, late December, but this will air on the date of launch of this report, and it will be live for people to go and download. Where should they do that?
So you need to go to the Search Invest Group website and go to the study tab. So we've got a 2023 study tab. And if you go to searchinvestgroup.com/study, you can download a copy of the study completely for free.
Okay. And there's just so, as I said at the top, this is a really big piece of a lot of data, a really sizable report, so much that we didn't even touch on. I mean, Robert kind of started touching on it on the end there about working with investors and the structure of deals and the financing and the returns to investors, not just to searchers, but to investors. We didn't get into really any of that. So there's just really a lot there, a real education for people and a resource as they continue doing their own searches. So I commend you guys on it's a really neat project and much needed. Thank you for coming on. Thank you for sharing it with the Acquiring Minds audience first. I really do appreciate that. Of course, the link, the URL that you just gave, Robert, will be in the show notes anyway, so people can just open that on their phones and click through and download it directly. We'll look forward to see how this study evolves over the years. There will be more to come from SIG on this. So thank you guys very much, and until we meet again.
Thanks for having us, Will. Really enjoyed it.
Thank you, Will.
I hope you enjoyed that conversation with Jordan Carter and Robert Graham of SIG. Make sure you subscribe to the channel below. I am releasing 2 new interviews per week now. So lots of great stories and content about buying businesses to come. Stories and content that will help you along your own path to acquire a business.